Welcome to this episode as the war with Iran drags on. Here with me to discuss a non oil consequence of the closure of the Straits of Hormuz is Ben Buckner, grains and dairy analyst from AgResource in Chicago, Illinois. Welcome to the show, Ben.
Andrew, it is a pleasure to be here. Thanks for having me.
Thank you very much for being a guest. Now, under the microscope in today's podcast, we'll be talking about urea, ammonia, phosphates, sulfur used to create fertilizer, and also liquefied natural gas or LNG required to create electricity for converting atmospheric nitrogen into plant food. When we focus, Ben, on the trade disruption resulting from the war with Iran and the lack of vessels leaving the Straits of Hormuz, it's instinctive to think of the logjam for crude oils, but it's not just oil and gas that's produced in the Middle East, is it? The region is a huge producer of fertilizer, isn't it?
Yeah, and I think a lot of the world is just learning that in the last 2 months. It's really come out that, markets, whether they've got perfect information or not, the price is the price. And suddenly we've seen a skyrocketing of all of those fertilizers that you listed, ammonia, phosphate, sulfur. And so it's going to be an increasing focus, I think, in the ag markets and food markets as a whole, depending on the duration that the strait is closed. But I think to start off with, until the Strait of Hormuz is opened nearly fully, this is going to stay in the headlines. And this is going to be something that we as ag market analysts and the ag markets themselves are going to be hyper focused on. What does 2027 bring? I think is where we are at the moment.
Could you describe the impact this is having on farming?
Yeah, and so we want to think about this. The details of fertilizer trade flows can be kind of opaque, or data's out very much in arrears. But we want to think about this, I think, through the lens of cost of production. And even as we see, generally everything is doubled when we think about fertilizer, and even taking a step back. One of the problems that we've got for a lot of the major exporting countries when we think about wheat, corn, vegetable oils, soybeans, this kind of predates what's happening in the Strait of Hormuz. This may be kind of the final nail in the coffin when we think about fertilizer pricing moving forward. But where these products come from, nitrogen, phosphorus-based fertilizers, it's always been China, North Africa, the Middle East, and Russia. And so if you go back to really 2016, kind of worsening trade relationships between the US and China, that kind of threw a wrench into this. China is an incredibly large exporter of phosphate-based fertilizers. It wasn't really much of an issue, but then we've got Russia's invasion of Ukraine, and then we lost the fifth largest exporter of total fertilizers would be Russia, and so then that threw another wrench. Now we've lost the remaining third, or the remaining third of the world's exportable fertilizer supplies have been kind of shuttered for now, and the duration again that we don't have access to at least reasonably priced fertilizers as anyone guess. So that's the issue for now. And whether we get supplies or not, the U.S. farmer, the Australian farmer, the Western European farmer, I think the market will be able to sort this out. But again, we want to look at this through the lens of cost of production. Corn prices, wheat prices, soybean prices are moving up, but not to the degree that fertilizer has. So when you start to do balance sheets for late 2026, 2027, in the next Southern Hemisphere growing season, you're really starting to stress Brazilian and Argentine producer balance sheets, to the point where now fertilizer as a percent of total cost to the Brazilian corn farmer is going to be double. They have got to double yields to see the same on-farm balance sheet that they saw really currently. So if they can't double yields because of maybe a lack of access to fertilizer supplies, then I think the world farmer increasingly is going to start thinking about planting something that's not as reliant on nitrogen specifically. So you're planting more oil seeds, less corn, less wheat. I think another maybe more direct impact of the nitrogen-based issue specifically is nitrogen essentially correlates to protein levels of wheat in Western Europe. And do they have supplies to apply that final coat of nitrogen-based fertilizer to the wheat crop in a country like France or Ireland or the UK? That's something that our contacts have said maybe it's going to be a struggle. And so if you don't get that last application of nitrogen on, May, June, probably looking at on the margin some kind of loss of nitrogen protein in the wheat plant. So you're going to have less high quality wheat, yields will be a different issue. But I think that's how it's impacting things from a very high level is costs of production are going up. Producer balance sheets are getting very tight to turning negative. And do they make the decision not to plant or to plant something other than corn or wheat?
I was going to ask you about the impact on this year's crop yield. You've explained a lot of it for next year, but is it the case that farmers are being a little bit more sparing with fertilizers at this point for this year?
So far, we have found, through our client base, I think a lot of what the media has found, and, different farms will have different coverages of fertilizers and applications, but for the most part, I don't think it's going to be a major issue for the United States, maybe even the Northern Hemisphere 2026 growing season. I think a lot of this was pre-bought. A lot of fertilizer in the US is applied during the fall. Of course, a lot of it is in the spring as well, but I don't think it's going to materially impact ideas of productivity, given that if our main concern is United States corn yields, once we get into September and October and our first kind of metric for productivity would be test plot data, certain portions of field grown to be measured. We've got several decades of history. When we get to that point, I don't think we're going to be able to separate what that field yielded. Was it fertilizer applications? Was it weather? Was it early emergence, planting date? So I don't think that we'll be able to know. And we're not terribly concerned about productivity in the Northern Hemisphere. But I think the issue is in calendar year 2026, we've got to do this all over again in the Southern Hemisphere, as early as late August. And what does the market look like then?
But is it the case that all crops are equal? Which crop is the most vulnerable from a squeeze on supplies of fertilizer?
It's going to be corn first and then the quality of wheat second. Though, again, if we include phosphate supply issues to the already very well known and clear nitrogen issues, soybeans, oil seeds will be impacted. But I think top priority for us is what does the producer do with corn production, kind of Southern Hemisphere, September onward. If you can't apply adequate amounts of nitrogen-based fertilizer, you probably are looking at a pretty significant ding in corn yields. And it's also impacting corn costs of production and corn balance sheets most significantly. When you think about the United States farmer, the Indian farmer, the Brazilian farmer growing corn, and they've got to double yields to meet or to match the balance sheet they saw in 2025. It's not quite as dire when you look at something like oilseed. So to us, it is primarily a corn issue.
Is there a tipping point along the timeline in terms of the standoff between US and Iran? How long can farmers operate before this becomes significantly worse?
I think it's more about seasonal demand for fertilizer. So one of the interesting things is, let's isolate the United States, like maybe Europe as well. Peak demand for spring fertilizer applications has come and gone. And so you really enter this lull period in that everyone had to pay more or less double what they paid for fertilizer this year. India suddenly bought in one tranche, 2.5 million tons of fertilizer to meet 2026 needs. So we can kind of go the next maybe 90 days without really impacting fertilizer balance sheet supply and demand, maybe even new price discovery to that extent. But I think we redo all of this starting September, October in both hemispheres. So I think that would be the sort of pinch point here. Knowing too that it's 40 days to get from the Middle East to a country like Brazil or Argentina or the United States. So if we haven't solved this probably by July 1st, I think the market's going to have to price something different or reset itself when we think about future grain productivity, food markets as a whole.
A final question off the cuff here. I don't think there are any futures markets. You just mentioned price discovery, but are there any futures markets that would address this issue going forward?
The CME has recently launched, kind of in addition to its, I think, existing urea contracts, short dated and smaller size urea contracts. And so volume, I think they're trying to pick that up, but they do exist and they are settled one way or another. But I'm going to look at the CME. They're trying to, coincidentally, becoming more active in the fertilizer space, during the winter months. And now it has been pretty timely. And we'll see if that contract picks up.
Ben Buckner, grains and dairy analyst of AgResource in Chicago. Thank you very much for joining me today.
My pleasure, sir.
And to the audience, thank you for listening. And remember to like and subscribe wherever you download your podcast from. Bye for now.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances, and, as necessary, seek professional advice. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at ibkr.com.